Good afternoon, everyone. So this afternoon, we are going to be looking at the topic credit risk. So far, we have done interest rate risk and we've also done operational technology risk. And you know that financial institutions are exposed to several different types of risk. And I've chosen to record this particular lecture so that you will have it to go over so that you can ask any questions when we have our tutorial sessions in the following week, and that you will have the opportunity to see some of the questions being worked out ahead of time. So I'm gonna share my screen so that you are able to see the slides. Just bear with me for a moment while I get this up. All right, so when we talk about credit risk, let's think about what that means. What is credit risk really? Credit risk is really the risk that financial institutions are not able to get the cash flows that they expect to get, right? So as they do that, if they don't get the cash flows they're expected to get, they're exposed to some risk. But before we really get into what credit risk is, let's just have a look at the learning objectives for this particular lesson. So by the end of the lecture, and by the time we have gone through the tutorial, you're going to be able to discuss and analyze credit risk associated with individual loans. You're also going to be able to discuss credit risk associated with the overall loan portfolio or loan concentration risk, as it is called, right? You're going to be able to understand the 5 C's of credit, identify them, explain them by the time we are finished with this. In addition to those broad objectives, you'll learn how to calculate the return on a loan. You're going to learn different types of models that are used to determine the level of credit risk that a financial institution is exposed to, right? So, like I said a couple minutes ago, we know that credit risk has to do with the chance that the financial institution does not get the money that it expects to get from the person that it gave the credit to. So, in other words, credit risk is a risk that they promise cash flows on financial claims, because financial institutions are not just banks. There are other institutions like, as we know, investment banks, insurance companies, mutual funds, all of those. And so financial institutions also invest in bonds. And so they are exposed to credit risk when they don't get the cash flows from these bonds. All right. Now, pretty much all financial institutions are exposed to this kind of risk. But the financial institutions that issue loans and those that buy bonds with the longer maturities are more exposed to it than those that issue loans, for example, short-term consumer loans, right? So it is really, really important that firms are able to identify those customers that are potential credit risks for them. All right. So what the institutions would do is to screen and monitor the persons that are applying for loans. All right. This is one of the most prudent credit risk management strategies. All right. And if they don't screen and monitor the loan applicants, then the chances that the risk they're exposed to will double, maybe triple, is very great. All right. And so the financial institution needs to determine what types of applicants they have, what types of applicants they are giving loans to. And so they go through a process of analyzing the risk that each client poses. All right. In addition to that, the financial institution would try to diversify its loan portfolio. Why? Because you have different categories of credit risk. So you have the credit risk that comes from a specific firm or a specific individual. All right. So that's firm specific credit risk. Okay. And the risk of default there is associated specifically with the type of company that the bank is lending to. All right. Then you have what we call systematic credit risk. And the systematic credit risk is that risk that arises from general economic conditions, specific macroeconomic conditions that affects all of the borrowers, right? So with the firm's specific credit risk, it's the risk that the bank or the financial institution is exposed to because of that particular institution, because of their financial situation, because of the industry that they are a part of. So this firm has specific risk to it. Then you have the systematic credit risk, which affects everybody. All right. Now, when we look at credit risks with regards to individual loans, the financial institution will take our deposits and then it gives loans to corporations, it gives loans to other individuals, it gives loans to governments, right? So you have loans to different people. Then you also have different types of loans, right? So loans go to specific categories of people, and then it also they also issue different types. All right. And so the financial institution has to be able to evaluate all of the information that it gets on its borrowers. Okay. So financial institution will look at the credit worthiness of a company, whereas it will look at the individual's ability to pay back the loan, right? And so what it does, it assesses all of the information it has on the individual or the company or the government in order to help it to issue a loan with the lowest possible risk, right? Now, it does that assessment, and based on the results of that assessment, the financial institution is going to determine, okay, this person or this institution poses a little bit more risk to me than another. And so I am going to charge that institution that has the potential to give me more risk, I'm going to charge them a little bit more money, right? So the financial institution is going to be looking for a higher return on the loan that it issues to an institution or a person which has higher credit risk. All right. And so it is going to charge more money to cover the cost that is associated with that particular risk, as well as the cost of the money that it's going to use. So because it takes money from us, from depositors, and it has to pay back the depositors, it has to give depositor some sort of reward for using the money. So what it charges on its loans has to be able to cover the cost of issuing the loan, right? And so we're going to look at that. So the financial institution is going to have to assess the cost of giving. All right. And so it's going to price the loan based on the loan or the bond. It's going to price it based on those factors. And we'll talk about them individually. All right. In order to reduce the credit risk, it's going to also set limits on the amount of credit that it gives to any one borrower or anyone. All right. And so that limiting how much it gives to one borrower reduces the amount of money that it will lose if that individual defaults on it. All right. If several of its borrowers default, then the financial institution can become insolvent. And later on, we're going to learn what the financial institution puts in place in addition to ensuring that it covers the cost of the loan, of issuing the loan. There are some other measures that the financial institution will put in place. All right. So now we're going to take a quick look at the types of loans. I'm not going to dwell on these. These you can read for yourself. So there's examples. You have loans to corporations, commercial loans or industrial loans, real estate loans, loans where given to purchase property. Then you have consumer loans, things like to buy furniture, to buy a car, mortgages, and so on, right? Now, financial institutions, when they're lending to very large companies, what they tend to do is more than one institution will come together to issue a loan to a single large company. And so this is what you call a syndicated loan. And so one commercial bank acts as the agent, all right, and negotiates the loan. What it does, what the syndicated loan does, is to allow financial institutions to reduce their risk. So the risk for this one borrower is spread across several banks. And so the agent is going to negotiate and ensure that all of the different elements in a loan transaction are addressed, right? So you're going to look at, the agent is going to look at things like rates, fees, covenants. We'll talk about those a little later, right? And so that is one way that a financial institution will spread its risk. Okay, reduce its risk by spreading that risk among several lenders. Also, institutions will issue secured loans where the loan is backed by collateral, all right? And so that is negotiated. And so the bank would have the first claim on whatever the collateral is. So for a mortgage, you're building a house, and so the bank will have a claim on the house, the first claim on the house. Usually with mortgages, the bank requires a deposit. So you have a dollar amount that you put down, and then the bank holds the house and the land as collateral. There are also unsecured loans, which the financial institution is not going to have the first claim on the asset, but it has more of a general claim if the person, if the organization or the company defaults on the loans, right? Then you have your individual or your consumer loans, and we spoke briefly about those. Like I said, I'm not going to get into details on those. You need to do your reading. So you have all those different types of loans, your car loans, your mortgages, and those loans, a car loan would be has to be paid back in less time than a mortgage, for example. Then you have what we refer to as revolving loans. You know it more as a credit card. Those are revolving loans. So the bank gives you, excuse me, a credit line, and you would pay back the bank as you over time. And of course, the bank is going to charge you interest on them. So what goes into pricing a loan? Pricing the loan meaning how much interest is the bank going to charge? How much fees is the bank going to charge? What goes into that? All right. So pricing a loan is one of the very important elements in the whole credit management process. So a financial institution will assess the borrower, and based on its assessment, the financial institution is going to price the loan. All right. And so the price of that loan, like I said before, is going to involve a number of. So what is the chance of default? Depending on chance of default, you're going to have a particular interest rate. Is there collateral? There may be a deposit that you have to put down, like I said, any fees. All right. And so we are going to have a look at that. There are different types of pricing. So you have what we call relationship pricing, where the bank looks at the type, looks at the customer. Is this a good customer? Um,